Good evening, everybody, and welcome to Redefine's annual results. In terms of our usual format, I'll just take you through a brief introduction, and then Andrew and David will take you through the detail. Okay, so just what we are, as I think most of you know, it's a listed JSE property loan stock company managing a diverse range of property assets exceeding 30 billion. Our unit price at year end was R9.60, and we make up 15% of the total of the market cap of the sector, and our total return to investors for the year to 31st of August was 30%. Our corporate structure has been simplified. We have our direct property portfolio, we have our listed securities portfolio. Since year end, the stake in Oryx has been disposed of. We have a small direct stake in Cromwell Property Group, was increased slightly. Redefine International, subsequent to their capital raise, we've now reduced our holding in RIN to 49, just over 49%. So the good news is in the coming year we don't have to consolidate, and our accounts will be a lot simpler and easier to understand. We have 76% of Redefine International fund managers as at year end, but that will shortly be increased to 90%. So from a Redefine point of view, why should you invest in us? We've got attractive real yields. There's a good prospect of capital appreciation. We have a high visibility of earnings, a diversified portfolio. We've substantially improved the quality of that portfolio. We do very limited speculative development. We're geographically diversified in the main into Gauteng, KwaZulu-Natal and the Western Cape. There's an element of rand hedge. We've got a proven management team which is being strengthened all the time, and there's no longer much reliance on fee and trading income. We say property is our commodity, but people is our business or our business. We, during the year, adopted values by our entire team and all of our staff. We've got commitments and values, and that's something which we're focusing on to make it happen. The highlights of 2012, final distribution of 32.5 cents in line with market expectation and previous guidance. Our recurring core income was up 7.2%. We've made significant strides in delivering on our strategic objectives. As I said earlier, the quality of our property portfolio has improved substantially. The average value per property has increased from 50 million to 80. Funding costs have been lowered through participation in the debt capital markets. We purchased the Fountainhead Manco. We've offered to acquire the Fountainhead assets. I'm sure there'll be lots of questions. We'll deal with that a bit later. And Redefine International has had a very successful capital raise and restructuring of its legacy debt. But Redefine has had a very quiet year. Okay, just looking at some of those things. There was the Fountainhead transaction. We bought some land in Cornubia. We bought the 50% in South Coast Mall, 50% of Chris Hani, the Discovery Building in Sandton. We disposed of our whole bunch of properties, 98 properties to Arrowhead. We did the deal with Arrow Creek on our trading properties. We purchased 50% of Dawn. We purchased the General Motors assembly plant. We purchased the Implats head office in Fricker Road. We did our deal with Zenprop. In addition to that, we are busy with two grassroots developments for Joshua Doe and Moorsport. We completed the Pepkor distribution centre very successfully. We refurbished Park Meadows, Scottsville Mall, Essex Gardens, Riverside Mall, all of which have contributed positively or will do in the new year. On our funding side, we had some equity raised. We went to the debt capital markets. We've sold Dipula and Oryx. So quite a quiet year. From an international side, there was a capital raising in Cromwell, which we participated in, and that Andrew will deal with, has been very, very successful for us. And on the Redefine International side, the debt restructure and the capital raise has also gone very well. So as I say, we unbundled the 98 non-core properties. We acquired 3 billion of other properties. The average value went up. The number of properties reduced locally from 358 to 253. And happy to announce today, if you haven't seen the announcement, that after a large and very competitive tender process, we were the successful bidder for the East Rand Mall from Sanlam, and we are accommodating Vukile, who had a preemptive right to take up a 50% undivided share in that. That's a 2.2 billion acquisition for 100%. We think it's a fantastic asset, and our fee and trading income as a percentage of total distributions has been significantly reduced. We focused a lot on our property management to grow income and lower operating costs. We developed the Redefine brand strategy, redefining relationships, and our positioning statement is we are not landlords, we're people. It's also translated into internal values and behaviors and launched to our staff. We've created a customer relations management department to make the business more customer-centric, and the property management structure has been revised to create a specialist management focus. The take-on of the Fountainhead property management has begun on a phased approach, and it will probably take us 8 to 12 months to integrate that properly, and we think we'll make a difference there as well. Our strategic review of our investments in listed securities to transform Redefine from a hybrid into a pure property play. There is a realization strategy for Hyprop in place to maximize the unlocking of the value. We've also obviously got capital gains tax issues. Hopefully some of that will be alleviated by the losses which we already have, and also with the advent of REITs. Our equity loans in Dipula were monetized, and an entire holding in Oryx was sold for 184 million subsequent to year end. Management of local debt. We've broadened our funding sources to the debt capital market very successfully. We've renegotiated some of our expensive debt, and we raised 650 million through an accelerated book build at a very tight discount to the price at the time. We've had real growth in international markets at low capital volatility. Redefine International raised equity of 127.5 million. It was originally planned at 100. They got over 130 and cut it back. Our Redefine International holding has been reduced to 49.3%, so we'll be deconsolidated. 250 million of Redefine International's legacy funding has been restructured. We've expanded our offshore exposure through a direct investment in Cromwell, and would look to increase that in the future, and increased our interest in Redefine International fund managers to 90%. Ability to execute value-adding development and corporate opportunities. We've always said this is something we're very good at. We're very good at adding value. So we've exited the speculative developments and reduced our dependence on speculative non-trading lumpy income. But just to give you some idea there of the things we did, Pepkor, for example, we had a building which was worth originally about 150 million. We spent 290 million on it, and in terms of the latest valuation, there's an uplift of 142 million. Park Meadows, which was 339 million, we spent 34. There's a 34 million uplift in valuation, and similarly with Jewel City, on a 34 million rand spend, we got a 43 million uplift in the valuation. So this is something which we continue to do. David will expand on it more, but it's something which we do very, very well. None of this would have been achievable without the support of my exco, our staff, and everybody else who's involved. So I just want to thank them all for their total commitment to Redefine, and I have no doubt that we will continue to grow from strength to strength. Now call on Andrew to go through the financial results. Andrew.
Okay, just looking at the financial results for the year ended 31 August. Some highlights. On a full year basis, we've achieved a distribution of 64 cents per unit, and that is in line with our market guidance. This time last year we gave exactly that amount, and we're pleased to have achieved exactly what we said we would a year later. Our total tangible assets are 42 billion rand, and we have a net asset value of just over 8 rand. Last year it was about 7.85 rand, and I'll talk a bit more about that in a short while. Our market capitalization at 31 August was 26.5 billion rand, and as Mark said earlier, we've broadened our funding sources to the debt capital market, which at the moment is very attractive from a funding cost point of view, and we will also talk a bit more about that in a short while. Our average cost of funding has been reduced by about 70 basis points to an average cost of 8.9%, and that's on the back of participation in the debt capital markets and also having renegotiated some expensive debt which was negotiated at a very different time in the life of Redefine. Our core operation has been solid. We'll unpack that some more, but you'll see that we've grown the core business by 8.3% in revenue terms, and that is a margin of 76.3%, which once again we'll explain how we achieved. And then I think lastly, which is very pleasing to see, is that we've been able to reduce our trading and fee income as a percentage of total revenue to, from a local point of view, to about 3%, which in our view is a wonderful achievement, because in the past we've always had a problem with non-recurring income, and we've moved our focus away from that in these numbers. Okay, just moving on to the distribution and explaining the 64 cents. If you look at the 64 cents, it will compare negatively to last year's total distribution of 68 cents. And in percentage terms, that's just under a 6% decline. However, one needs to take into account a couple of facts. One being the non-recurring income in 2011, 4.6 cents, most of which was for the Hyprop transaction fee. And then along with that was the Arrowhead unbundling that contributed 4 cents to the 2011 numbers. If one excludes those two elements, along with dilution arising from additional units that were issued during the course of 2012, you get to a recurring base of 58.5 cents. And you will see that that grows by 7.2% in this financial year to 62.7 cents. And yes, we do have some non-recurring income this year of 1.3 cents, taking us to the 64 cents. Looking just in terms of the spread of the distributions per linked unit, you'll see that in the first half, we only grew by 2%. The reason for that mainly was because of Arrowhead having been unbundled in the first half. And in the second half, you'll see quite a big decline of about 12%. Once again, Arrowhead is a factor. Along with that would be the Hyprop transaction fee that was earned in the second half of last year. Once again, backing them out, you'll see that there would be positive growth. Looking then just at how the contribution for the 2012 year has come about, you'll see that the bulk of our earnings come from the local property portfolio. This is in cents per linked unit terms, 71 cents. We do have listed income of 14 cents, small trading income of 2.3, that's reduced by admin costs of 4.3 cents, and then you'll see interest costs, and this is for the local operation, of 25 cents. Now that 25 cents in relation to the revenue that is generated is approximately 26%, which we believe is quite a pleasing ratio. The local contribution totals 57.7 cents. In percentage terms of the total distribution, that's 90%. And you'll see that the international operation has generated 6.3 cents for the 2012 year. Moving on then just to the detail of the distributable income. I'm not going to dwell too much on the top line, where the bulk of our revenue comes from, because we deal with that in detail later. But that's grown in total terms by just under 1%. Listed securities 4%. The reason for why it's only 4 is because in 2011 we recognized some pre-acquisition income from Hyprop, which was a once-off benefit. Fee income has reduced quite significantly from 2011. The reason for that is because of the Hyprop transaction fee. And then property trading income similarly has reduced, and the reason for that is that because we've exited out of a number of speculative trading joint ventures that we had in Cape Town that we sold to Arrow Creek, And then also there have been sales at Buchanan, which is also in Cape Town, that have been quite subdued in this financial year. Admin costs, as you can see, have grown quite substantially. Most of that increase has arisen from two elements, one being the marketing focus that we've embarked upon, that Mark spoke of earlier, and also our phantom share option scheme had to be lifted given the share price appreciation over the past couple of months. Share of distributable income of associates, as you can see, has jumped up quite nicely. The reason for that is the Cromwell income that we receive directly, we've put in as an associate because we account for it on that basis from a group point of view, given our 27% holding through Redefine International combined with ours. Finance costs, as you can see, have only increased by 4.4%, even though our funding levels have increased. And that comes back to the 70 basis points average reduction in finance costs. The international distribution, as you can see, has increased by 29%. A big part of that has been the conversion of foreign income into rand. There has been some rand weakness of late given the market volatility that has arisen from labour unrest and so forth. But there has been underlying growth in the international business, which Mike Waters will talk about, arising from the Witchford transaction. Looking then just at the core properties, you'll see, if I just move from the bottom upwards, because that number I would have spoken of earlier, if we split out the investment properties performance between core and then exclude items that are not in for a full period in 2011 or 12, arising from acquired or disposed properties, you'll see that the property income from the core portfolio, that's properties that we've owned for 12 months in both periods, has grown by 8.3%. The revenue, which I'll unpack as well in a short while, has grown by 6.6%. But I think what is more pleasing is to see a 1.7% cost increase, giving rise to that 8.3% improvement in the income from the core business. Once again, the margin, as you can see, grows from 75.2% to 76.3%. And once again, I'll show to you how that comes about. In terms of the revenue performance, this is revenue. I think David will speak more about square meterage, which is his currency. But obviously the two go hand in hand. So in a very competitive market, the revenue and the square meterage kind of don't talk to one another. But having a look at it from a revenue point of view, what stands out is that on a total basis, vacancies have given rise to a decline in revenue of 74 million rand. However, and it's coincidental, it's not by design, but new lets have replaced that lost income. So in revenue terms, we've stood still. From a vacancy point of view, we've been able to replace the revenue we've lost. And you can see from renewals, we have been able to eke out some income there, 23 million rand, which has given rise to a 1% growth. And the bulk of the growth obviously coming from contractual lease escalations, which run with our leases. Once again, looking at it on a per sector basis, offices are in a difficult position with their vacancies exceeding their new lets in revenue terms. Retail has held out, and we've done very well on the industrial front. And this is the benefit of having a diversified portfolio where you are able to mix and match. Year-on-year growth, as you can see, despite this challenging environment, is all in excess of 6.5% on the sectors, giving rise to the 6.6 overall percentage growth. Moving then on to the core property expenditure analysis, you will see here that we've done very well this year on the pressure points, being municipal charges, net of recoveries, and similarly electricity charges, net of recoveries. In both cases, we've managed to either hold them flat or slightly reduce them, and that will be an ongoing focus, because as landlords, that is one area of the business where we do have significant pressure going forward on an ongoing basis. Bad debts, as you can see, has crept up. That's a function of the economy, and hopefully next year that will improve. I'll talk a bit more about bad debts in a short while. And I think the other item just to highlight here is repairs and maintenance. We've had a year where we've had to dip into our pockets a bit more than we would have expected. However, this is good spend in that you spend it now, you avoid it later. There's always a temptation to defer repairs and maintenance, but it will always come back and bite you when you least expect it to. And 2012 was the year where we decided we'd rather spend than rue the decision later on. And then just coming back to the ratios, you'll see that they're all healthy. We went back to 2010 just to make sure that it wasn't a once-off benefit. And you can see that property management is making a big difference here to overall costs. Property management costs, although in revenue terms it doesn't look like it's made a big difference here to the base, you'll see in the next slide that it does have a significant impact. What I've done here is I've taken for every 100 Rand of property revenue, you can use it as a percentage rather than Rand if you like, and you can see how the property costs actually impact on our margin of 76.3%. Going back to 2010, you'll see that net municipal charges and electricity charges were about 4.2% of revenue. Currently, it's sitting at about 5.1%. However, if you look at last year, it was significantly more than that percentage. So there we've made a difference this year, giving rise to some of the margin improvement year on year. I think property management, if you look, has declined from 4.5 down to 4. And then bad debts, I just want to mention, has basically doubled since 2010. I think it's going to come back a bit in the new year. But once again, for a business of this size, to have bad debts under 1%, I don't think is a big issue at all. And then coming back to management fees, you'll see a huge reduction there of 4.4% in 2010, moving down to 0.7%. And that's where the benefit of internalizing property management has come in on that line. And yes, it has been offset to some extent by the net municipal charges and electricity charges. However, we've still got a significant benefit overall. Looking at the balance sheet, just some areas that I'd like to just point out on 2012 versus 2011 first. Investment properties, David will talk a lot about, so I'm not going to dwell on that growth there of 1 odd billion rand. Listed securities, we've had a fantastic run on the Hyprop share price, which has resulted in most of that growth from 4.7 billion rand to 5.3. Intangibles have grown. That's as a result of the acquisition of the Fountainhead Management Company. Interest in associates, that's been the Cromwell investment. As a group, we participated in December last year in a capital raise, giving rise to an increased investment in Cromwell, but there's also been good capital appreciation in that investment. Moving down, you'll see debt. We'll talk a lot about in a short while, so I won't dwell on that one, but you'll see that there is reductions in the debt year on year, but a lot of it has moved down to that non-current liabilities held for sale line, where significant restructuring has happened in the international business, which in the new year will all be taken out of this balance sheet, hence the reason for disclosing both non-current assets held for sale and liabilities held for sale, because the two are linked. Mark spoke earlier about decreasing our investment in Redefine International. That reduction to 49.3% has resulted in us to be able to deconsolidate our balance sheet. So what I've done on the far right-hand column, I've provided you with a 2012 balance sheet on a deconsolidated basis. And what I'm highlighting with those red blocks there on certain numbers is on the assets that effectively are taken off balance sheet, but similarly there is non-recourse international debt that also disappears with those assets. And as you can see, the two almost offset each other. The net result is that our net asset value on this basis improves by about 22 cents, which is on the next slide. You'll see that our net asset value as a group for 2012 has increased. The main reasons for that is because of the local appreciation in value of our investment properties, as well as listed securities, And we also had a capital raise of about 650 million rand during the course of the year. International, however, you'll see an 18 cents decline. That has arisen from mainly restructuring of debt. I think the Gamma facilities are sitting in that number. And then there are also shopping centres in the UK that are also feeling the brunt of a very fragile economy in the UK, which is also driving to some extent that number. But most of it would be as a result of debt facilities in the process of being restructured over there. The Arrowhead unbundling is also impacted to the extent of 30 cents on NAV. And as I said earlier, the value of, or the net asset value of the deconsolidated group at 822 cents is essentially what we will be using for the Fountainhead transaction as currency, and that's an important number for us going forward. Looking at our listed securities, the bulk of our listed securities are in Hyprop, as you can see, 5.3 billion rand, and there has been some movement here. What this slide will show you is the intent of Redefine to be exiting out of its listed security portfolio. We've already sold 2 million Hyprop units, resulting in that decline from 31% to 30.4%. And then Oryx, we sold in the last week of September for 184 million rand, and that line has been taken to the non-current assets held for sale, pending their disposal. That transaction, by the way, took 7 months to consummate. It's an illiquid stock, and it was sold to a consortium of local investors. The Fountainhead Property Trust, as you can see, we got a very small holding there as a result of acquiring the Manco. Cromwell, as we said, has grown, and that has been through the participation of Redefine investing directly, as well as Redefine International participating with Redefine in a capital raise in December. In terms of funding, local debt is just over 9 billion rand, and that is what we manage here on a daily basis. You'll see that the bulk of it is from bank borrowings, and over time we'll be looking to up that to 30% of the total. So any new debt that we require, we intend going to the debt capital markets for, and possibly any facilities that come up for renewal that we can't repay through the sale of assets such as Hyprop and so forth will also come from the debt capital markets. Non-recourse international debt sits at 11.5 billion rand, and these are gross numbers because some of that debt, about 1.2 billion thereof, is sitting in non-current liabilities held for sale. But the total borrowings on balance sheet is just under 21 billion rand, and you can see it's about 3 billion rand more than last year. In terms of local loan-to-value ratios, we're very comfortable at 32%, with our target at 35%. As I said earlier, our weighted average cost of borrowing sitting at 8.9% versus 9.6% last year. And then the level of fixed debt, currently at 68%. Our target is 65%. And we have a projected funding headroom of just under 500 million rand. Moody's refreshed their credit rating on the 12th of October, and we're happy to say that it has remained unchanged. And for us, that's good news, given that most other institutions out there have been suffering from downgrades of late. Looking then just at the cash flow, I think the important takeouts here, if we just focus on the local line for 2012, is the productive use of cash. Whatever spare cash we have, we reapply to debt. We've got drawdown facilities whereby we can place debt with the funding providers, and you'll see that we've raised 2.2 billion to invest 2.3. So all we're trying to do is minimize our cash on balance sheet through keeping as much of the free cash that we have applied to debt and drawing as and when we require it, and that is a delicate balancing act, as you can see. Just looking at the generated by operations, we're quite happy with our ability as a group and as Redefine locally to be able to more than sufficiently cover our interest paid to institutions as well as to our linked unit holders from operational cash flows. Okay, just looking at the unit holder profile, there's been quite a bit of movement in the top 5 here. Stanlib have consistently been at the top, but the balance have moved around, and as you can see, the government employee pension fund is now moved into the second slot at 5.4%, Old Mutual at 4.8%, and so it carries on. There is one international investor, State Street, at 4.4%, being our number 4 investor at this point, and they've come from nowhere onto that position. I think another welcome addition to this top 10 list here has been the Eskom Pension and Provident Fund, who also have appeared from nowhere, having sold their stake in Pareto to the PIC and having cash to invest. So the top 10 unit holders comprise 40% of our total our total unit holders out there. Looking then just by country, the international investment interest in South Africa sits just under 15% at the moment. But what is of interest is looking at the bottom left-hand side. In 2008, we had just over 1% foreign ownership. That's grown over the years to 15%, with most of the growth coming in the last year or two. Redefined share price, as you can see, has ticked up quite nicely. If one has to update it for the last few weeks, we could well see that line going the wrong way. But I think what is of interest would be the volumes traded. As you can see, Redefine has had significant volumes over the past while, and a lot of it has been driven following the Fountainhead Manco acquisition. Just looking at total returns, Mark did speak earlier about a 30% return to the unit holders, and I thought I'd just provide some academic backup to his statement. And as you can see, I've done an analysis here, removing the Arrowhead unbundling out of the numbers, just to give context to how Redefine has added value to its unit holders had they have held the unbundled units for the 2012 financial year. We've adjusted the opening price for the unbundled NAV, which was the listing price of Arrowhead, of 30 cents on a combined basis for the Redefine unit holder. And then what we've included in there has been the 2012 distributions declared by Arrowhead, as well as Redefine's. As you can see, Redefine is just over 29%. Arrowhead has shot out the lights at just under 38%, and on an overall basis, we arrive at 29.9%. With that, I'm going to hand over to David.
I'm going to give a high-level overview of the portfolio. There's been a significant change in the shape of the portfolio over the last year, which essentially shows progress in achieving the strategy of acquiring a better quality property, higher value, well-located properties with good tenants and good leases. The asset value is now 21 billion, up from 2 billion last year, with an increased property value from 50 to 80 million per property, and a reduction in properties from 358 to 253. So it gives you an indication of what's happened with the shape of the portfolio and how much it's changed. There's a total GLA of 3.1 million, which is pretty much in line with last year's, and a vacancy rate currently of 5.8%, which is certainly the lowest it's been in the last 3 years, and has come about due to various aspects, acquisitions, disposals, and letting activity. There's a renewal success rate of 79%, although our goal would be at least 85%, so we're not happy at that level. And then there's been a renewal growth rate, which I think is probably comparable, if not better than our peers in the marketplace, but has been negatively impacted by 3 large office lease reversions. The investment, as you can see with the sectoral spread, the investment in the office sector remains the most dominant, be it value, GLA, or numbers of properties. However, it now consists of a higher quality of property, again in line with our strategy. Insofar as the geographical spread is concerned, it's predominantly Gauteng, KZN, and Western Cape. Again, it's essentially the strategy that we set up. Within those areas, there are identified hotspots within which we've been acquiring property. And then we have, I think it's important to note that we have regional offices in each of these areas, covering all the property management skills capable of managing these portfolios. Again, the top 10 properties by value. Again, this very definitely reflects the change in the shape. The other interesting thing is that within the top 10 properties, there's no longer a property which has government as a major tenant. I think up until now, certainly since the merger, that's been the case. And then what I'd like to do is just comment on these properties in terms of the activity that's taken place over the last 3 years. If you look at Golden Walk, we added 12,000 square meters to Golden Walk about 3 years ago. Standard Bank Centre, we're about to do an upgrade in terms of parking. Pepkor Isando, we've just done the 66,000 square meter extension. The Discovery Building we've recently acquired. Sammy Marks, we acquired the third leg of the 3 sections during the course of last year, and we're now looking to add some additional retail. Park Meadows, we've recently put in the Food Lovers Market and added 3,000 square meters of additional retail. Cleary Park, we extended by approximately 10,000 square meters about 3 years ago. Convention Tower is a property that's only coming up to 5 years. And then Tywell Square is a property that we've recently purchased, as with Commerce Square. So you can see within the top 10 properties, there's been a lot of redevelopment activity that's taken place. Multi and single tenanted properties. Our strategy was always to achieve a situation where approximately a third of the properties were single tenanted. It's likely that the single tenanted retail properties in time will be replaced with higher value single tenanted retail properties. The sector vacancy by region, just an overview of where the vacancies lie at the moment. The Western Cape essentially is no large vacancy in any one particular building. It's spread across the portfolio. Gauteng, the large office vacancy, is currently in 90 Rivonia Road, which we are probably going to redevelop. That's approximately 15,000 square meters. And otherwise, in 222 Smith Street and 209 Smith Street in Braamfontein, and in time they probably will be disposed of as well. In fact, we have an offer which we've accepted on 222. The remaining office space in Gauteng and in KZN exists in CBD properties. I think just in terms of what's happening in the office market, we don't anticipate any improvement to B and C grade properties for the foreseeable future. A grade properties, essentially rental levels are drifting. We've seen that. We've now let 82 Maud 100%, and we've seen rental levels there between 125 and 145 rand a square meter. So you're not going to see growth in A grade properties, but certainly in P grade properties with high Green Star ratings. That's where the growth in the market currently sits. The gross lettable area and vacancy movement. Well, the slide is in 2 sections essentially. The first slide, the top part of the slide reflects the movement in GLA over the past year, and the bottom section reflects the movement in lease activity over the year. So as you can see, as indicated, 3.1 million square meters of space, 173,000 square meters of vacant space, just under 6% in vacancy. And you can see that the extent of leases that expired during the course of the year was deemed a risk at the beginning of the year because of the quantum. We've managed to renew, however, 79%, and as I indicated previously, our intention is to, well, certainly our goal would be to increase that to closer to 85. So at the end of the year, our vacancy sits on 5.8%. The letting activity for the year, I think what's noticeable here is that we have shown renewal growth in each of the sectors. Certainly given that there were 3 large negative reversions, and I'll show you on the next slide. In the office space, certainly at the beginning of the year, we didn't expect to show positive growth in offices. Retail, I think, is pretty much in line with market, although again, for the coming year, we'd like to think that we can improve on that. And I think that industrial, we've done reasonably well. I think that what's interesting is the value of leases concluded is approximately 2.5 billion rand. And this slide, it's got lots of information on it, but it shows the three large reversions. That was the Vodacom in Pier Place, the Alexander Forbes, and the Accenture properties. Had we been able to renew those leases with growth, we'd have seen probably 4 or 5% growth in rentals in the office sector. The top 10 new deals by value. I think what's important there is that the top 3 are all as a result of development or redevelopment activity in Pepkor, Hammanskraal and Park Meadows. And then the month-to-month leases. These are all leases with government as the major tenant. And I'm essentially showing the slide to show you the type of risk that exists. Yes, we will get the increases in rental. It will take a while to get them, and you could take a view. Some people may say this is an opportunity in terms of business. I think from our perspective, in terms of growing and reshaping our portfolio, it isn't any longer. And I think that our motivation certainly is that we would be looking to dispose of this portfolio in the medium term. The lease expiry profile by let area. Again, the majority of the monthly leases is made up of the office leases which house government, and there's about 700,000 square meters to be renewed during the course of the year. We're not concerned, notwithstanding the fact that it's a large number. There are a lot of large tenants who we're negotiating with at the moment, so we're not concerned about the quantum. And that's an overview of the acquisitions and disposals that have taken place during the year. We've acquired 2.6 billion during the financial year, which have been transferred. There's a further 2.3 billion which have been acquired but not transferred, 2.4 disposed, and another 170 million of disposals not yet transferred. That's the list of the acquisitions. I think what's important there is are the big ones: 155 West Street, the Discovery property, Tybalt Square, currently under head lease to Zemprop for another 2 years. Chris Harney Crossing in Vosloorus, which we bought in partnership with McCormick Group. 22 Fredman Drive, which houses Eversheds in Sandton, and then the 2 industrial properties, Dawn and the General Motors outlet in Kucha. These are the properties which we've acquired which would be transferred after August. The Nickel Grove portfolio we are reconsidering. There are certain town planning issues that haven't yet been finalised, which gives us the opportunity to reconsider whether we do proceed or not. But as indicated by Mark, we've acquired 50% of East Rand Mall for 1.1 billion. Obviously that has an impact in terms of the shape of the portfolio as pertaining to retail, etc. But it's an exciting acquisition. And that's just the top 5 acquisitions and some detail by property. These are the disposals that were transferred during the financial year, 2.4 billion. And again, the majority of them the majority of the properties made up through the Arrowhead and the Arrow Creek disposals. The other 2 large ones being Waltloo, an industrial property just outside of Pretoria, occupied by Public Works, in the process of vacating, and we've sold it to ABSA. And then there's 7 smaller properties which will be transferred during the coming months. Current developments, again 720 million rand under development, initial yield of 8.7%. The important one there, I think, is 90 Grayston Avenue in Sandton, where we're building a 19,000 square meter office block, which is currently underway. And some slides showing you how the portfolio has been or is going to be improved. That's the 90 Grayston. It's Essex Gardens in Westville in Durban, where we built a new office block with parking and have refurbished an office block for TBWA. Maynard Mall in Wynberg in the Cape, where we've done a facelift upgrade. And future developments, 90 Rivonia Road in Sandton, which we'll be looking to redevelop during the course of the coming year. There are 5 large users of space looking for space in the Sandton area, each looking for between 25 and 35,000 square meters. We're on the short list in each case, so we're hoping that we can land one of those. Rosebank offices is a development here in Rosebank that we're on the short list. There are three parties involved. Matlasana, big one up in Northwest, the shopping centre in Klerksdorp. We acquired the development approximately a year ago. There's one more objection that needs to be met, and then we can get in the ground and get underway. And then the other big one is Sanderbank Centre in Cape Town, where we're looking to add parking decks. Completed developments, well, the big one there really is the Pepkor industrial space of 66,000 square metres out in Isando. And again, there's an indication of the Pepkor warehouse. I think enough has been spoken about it during the course of this presentation. That's the Park Meadows, where we've added the additional 3,000 square metres and food lovers market. Scottsville Mall in Pietermaritzburg, where we did a total re-tenanting and refurbishing. And Shoprite Parow in Cape Town. That's it. Thanks.
Good afternoon, everybody, and welcome to the 2012 year-end results for Redefine International Properties Limited. And I will use the acronym RIN to talk about Redefine International. And Redefine International PLC, which is listed on the London Stock Exchange, I will use the acronym PLC. Just to start off with, we set out our vision last year. And I think 2 out of the 3 we a long way along the line to meet, and that is to be the leading diversified mid-cap cash flow focused property investment company dual listed on the LSE and the JSE. Through our diversification strategy to provide industry leading hard currency income returns to unit holders. I think we're doing that at the moment very well, and we hope to continue to do so. And lastly, to develop a transparent and simplified corporate structure, including the possible conversion to a UK REIT or indeed a South African REIT, if that makes more sense. The highlights for this year is that we met our earnings forecast that we set out last year in 2011. We successfully restructured and repaid over 250 million of legacy debt. More of that I'll talk about as we go through, largely the debt we took on when we merged with Whitchford. We had a very strong performance from the hotels and Cromwell. We have integrated the Whitchford business into our business, and that's gone very, very well, and it's settled down into a very well-functioning setup in London. We have made numerous disposals and asset management activities, which will enhance the overall portfolio quality. And we've got some development projects underway, more of which I'll talk about during the presentation. And then lastly, the capital raise, which was highly successful, where we raised over 1 billion rand in South Africa, which translated to 75 million pounds, and a further 60-odd million pounds in the UK, for a total of about 127 million. The highlights from a headline point of view, the operating side, quite flat really. The occupancy dropped slightly. Indexation, which you call escalation in South Africa, improved, which was good to see. And our weighted average unexpired lease term has dropped marginally, but is still very strong at over 8.5 years. On the financial side, the distributable earnings that we have increased 20% to 18.2 million. The headline earnings per unit increased 12.5%, and distributable earnings per unit, and because we then distribute all our earnings, the numbers are the same at 4.38p, and that was 6.6% up for the year. Net asset value was an area where we dropped, and I'll take you through the reasons for that, due mainly to the valuation declines in the old Whitchford portfolio. Looking at it in rand terms, headline earnings per linked unit were 19% up at just under 96 cents. We had 2 distributions in the year, the first one at 26.8, the second one at 32, which will be paid on the 3rd of December. That's been forward fixed at a rate of 14 to the pound, 14 rand to the pound, which gives us the total distribution for the year of 58.9, or 21% up on last year. The fully adjusted net asset value per unit is 5.07 rand, and if we take into account that we issued our new units in the capital raise at 4 Rand 60, we now have a pro forma post-capital raise NAV of 4 Rand 91, which is a dilution of 3.2%. Distributable earnings, that just sets out how we get from our rental to the bottom line of 4.38, and it gives you the breakdown of the various bits and pieces that make up the income statement. As I said earlier, the portfolio valuation is where we've seen a decline, largely in two areas. The first one, what we call our UK stable income, and that's largely the Witchford portfolio made up of UK government-let offices, and we had a valuation decline there of about 10.7%. A lot of the valuation decline is in the two funding facilities that we have, one called Gamma and the other called Delta. It's in negative equity, which means because it's of a non-recourse nature, we'll never have to put the equity in, but until we dispose of those properties, we have to carry it on our balance sheet, and that's why we're seeing such a large decline in the net asset value. The UK retail side, well, this silo business segment of the portfolio was the one that we had the most trouble with during the year. Certainly it's been well documented about the troubles of UK retail, and specifically administrations of a large number of UK retailers. We believe we're over the worst, and the 9.4% drop there is part rental decline and part cap rate on the yield side, net initial yield. The European portfolio, effectively in sterling terms, it dropped 7.1%, but that's largely because the euro dropped against sterling, and the real drop on the European side in euros was approximately 1.7%. So you've got a 7.1% drop, but remember you've also got a drop on the other side with your debt, so the two almost balance each other out, and you've got a 1.7% drop overall. Hotels were constant, good performance from hotels, and Cromwell, exactly the same thing. The Australian dollar weakened against sterling, and that's why you got a slight drop of 0.4%. The good news on Cromwell, as I'm sure you know, is that post year end, we've had a further increase in the share price of about 10%, which takes you up another 10 odd million pounds. And just to show you how the balance sheet is made up with our net asset value per share, you'll see in the block there, I've got the two items highlighted called VBG negative equity. That was one of our facilities that we restructured post year end, and Delta also, those have been added back. Then just moving on to the capital raise, we had a very, very successful capital raise. And on the South African side, we had the RIN pro rata issue of units for cash, where we issued 218 million new units at 4 Rand 60. 1 billion Rand was raised, and we were fortuitous that we were able to fix the rate at which we took the money out into the UK at 13 Rand 31. The Rand dropped about 10% about a week after that, so it was very fortunate. So that meant 75 million pounds was raised, and it was good to see we had a 94.9% take-up, and in fact with excess applications and selling down part of the redefined stake, it was diluted to 49 point. Unfortunately, a slight error has crept in here. It's 49.3, not 49.8. So I just need to point that out. Moving to London, on the PLC side, a total of 127.5 was raised. 104 million from the open offer, which was taken up 96.4%, which was very, very good news. We were concerned about the minorities in London, which meant the firm placement element of 23.2 million had to be increased slightly by 3.75 to take up the slack between the portion that took up the open offer. In that process, RIN was diluted to 65.7%, which means the shareholder spread on the London Stock Exchange has increased quite nicely to 35%, which is good news for liquidity and for spread purposes. And in the process, we've broadened the share register, and we now have some very large UK institutional investors on our share register, which is excellent news. The group structure, as you can see, we've got in the red corner Redefine Properties at what should be 49.3%, which owns Redefine RIN on the JSE, which in turn owns PLC. Your minorities there are split about a third in the UK, a third in South Africa if you do it on a look-through basis, and Redefine owns approximately a third of the PLC. Use of proceeds, I've split this into three parts. The completed transactions, which has taken up about 53 million. The agreed transactions, about 16. And then potential transactions, I'm sure you've spoken about the Cromwell potential rights issue, which is a possible investment. And then we have Gamma restructuring, where we could well see ourselves acquiring some of the assets out of that facility. And then lastly, we're looking to restructure or put money into a new shopping centre in the UK, and in total that comes to about 60 million. On the operational side, the slides are all in the booklets, and the information is on the website for those that would like to look at it on the website. And just to confirm that we have 5 silos in our business: UK stable income, which is largely the government office portfolio; the UK retail side, which is our shopping centres in the UK. We've got Europe, which consists largely of retail, and the VBG portfolio, which is a government-led office portfolio in Germany. Our hotel portfolio is based in London, and the Cromwell Property Group in Australia, in which we have 23.08% stake. Each one of these is set out in the document and will be on the website. And really, we've just set out there what's happened in terms of the operational side, the asset management side, how many leases we've signed, and what the void rates are. So UK stable income, other than the valuation decline, is going fine, and certainly the UK government does pay its rent. On the UK retail side, although it has been a tough half year, the occupancy has increased. We've signed 31 new leases, which total 125,000 square feet, and that takes into account the 90,000 square feet of leases that expired. Europe, we're close to 100% occupancy, which is very good. We've got long leases with the discount retail store sector, and we had 7 lease extensions, 3 store expansions, and 2 full renovations. The other interesting thing is we've tied up with Menorah, one of Israel's major pension funds, which is a big coup for us and for our team in Germany, and they helped us with the VBG restructuring, and we look forward to a long relationship with Menorah going forward. On the hotel side, the Olympics was very, very good for us. We were worried about post-Olympic slowdown. That hasn't happened. It's gone from strength to strength, and we're looking forward to a very, very good year going forward, and hope to expand and to grow that portfolio by acquisition. And then Cromwell, again, a very good investment for us, well managed, well run, and has given us superior returns. And certainly the share price in Australia is reflecting that, where the current share price is trading at around about 84 cents. And that shows a graph of Cromwell relative to the Australian index. As I said earlier on, we've got some development projects that we're looking at right now. The biggest one is in Harrow, where we recently had a rezoning application passed, and we're hoping to get on site there to build out this 316,000 square foot mixed-use scheme with a JV partner in the middle of next year. Our Birchwood Warrington redevelopment, we finished the first phase, and we're hoping to be fully complete by the middle of 2013. And then St George's Harrow, our big shopping centre in London, we had planning for 2 new restaurants, and we've got 2 operators that we signed up there, well known in South Africa, international operators. And in Croydon, and that's next to the Hammerson Westfield massive redevelopment precinct, we've got a building that we're looking to convert to a hotel and residential. And then on the various government-led offices, there is potential when the leases expire to convert to residential or to retail, and we're looking at many of those to start the process to get the ball rolling to convert those when the government vacates. Our lease expiry profile, you can see, is very smooth except for 2018, where we have a number of expiries on the government side in Delta and Gamma, and hopefully in the restructuring process we'll actually move those buildings out and we'll lose the expiry profile problem that we've got, the hurdle in 2018. Other than that, it's a very smooth expiry profile for the next 10 years. And just to confirm, the facilities that we restructured or repaid in the last half year, coming to 254 million, VBG, Aviva, Delta, Gamma, and also we sold Halle in Germany for 37.1 million and took all that debt off the balance sheet. Our debt maturity now is a lot better than it was a year ago, where we've got a smooth expiry for the next 5-6 years, and then a big expiry of 270 odd million in 2022 plus. A lot of that is the Aviva debt, which is all 25-year debt, expires closer to 2030. So a very, very good expiry profile there. The road ahead, well, as I said, we've got a R5.07 net asset value against the current share price of about R5. The forward earnings per unit, we were forced to disclose to the JSE, and I've taken the mid-range here of what we disclosed in our results presentation yesterday of 3.2p. That's not a forecast, it's just the disclosure. But if you take that at 14 to the pound, you're coming out at just under 45 cents per unit going forward. The current yield, and I've used the RIN-C, the convertible unit, which doesn't have the current distribution in it, the current yield, forward yield, is about 9%. And our pro forma loan to value now, which is really what the key issue is for us, having reduced our debt, is sitting at just over 50%. So what lessons have we learned? Well, I think the key one for me is that Witchford deal was expensive. In retrospect, we didn't realize, or we didn't think the office market the regional office market would drop as much as it has. In any event, we did get cash and ungeared property to the extent that when we merged the deal. So we didn't overpay, we just didn't get what we thought we might get down the line in terms of added value. Gearing has a significant negative impact, as you can see, in a deflationary environment. So where values are going backwards and you have gearing, it's a multiple effect. It's a double whammy. But income is and always will be king, and our portfolio is very, very strong on the income side, and that stood us in good stead. And I think what we have to be very careful about right now is there are a lot of properties on the market. A lot of banks are getting rid of their properties. A lot of companies are insolvent. But you have to be very, very careful what you buy, because not everything that's cheap is a bargain. Having said that, though, notwithstanding a very difficult period, we've met all our forecasts since we listed. We've paid all distributions in cash. And our portfolio sale of those properties that we still own in negative equity is probably the route we're going to have going forward. But if I summarize everything, since listing, we've had a total return, if you held onto your shares, adding back the dividend, of just under 17%. So in light of the extremely tough conditions, I think it hasn't been a bad investment. Finally, what are we going to do going forward? Well, we've got a strategy that says where and how we're going to look after the portfolio. Further rationalization. We've got too many properties of too small a size. We want to get to maybe half the number of properties, twice the size, something like that. We need to get rid of the negative equity, which we're close to doing. We'll only allocate cash to those investments that will give us at least 10% return on equity. Priority is the silos showing returns, and at the moment that's Cromwell, hotels and Europe. And what we have to do, because the banks are effectively closed in the UK, is find alternative sources of debt funding. And certainly the bond market is one that we're looking at. I know you're using it here in South Africa, and there is a definite opportunity for us there to tap into the bond market. Growth in distributions, I'm asked about that. I think it's going to be inflation plus. I don't know what the plus is, but certainly with inflation running at about 2%, we need to at least beat that. And development gains from the projects that I showed you are going to start adding some profit, and we can recycle that into new income generating assets. So the outlook, the UK is emerging from recession at last. The last quarter was the best growth in about the last 5 years. However, the Eurozone could fracture, but we're in the very strongest part of the Eurozone. We're in Germany and Switzerland, and that's going to remain strong. I think Australia, the worst is over. It seems to have bottomed out, and hopefully we'll get some further growth coming there. And what we have to do, notwithstanding what I told you about there being a lot of assets available, we've got to look for some good assets and take buying opportunities while they're still available. Because if we come out of recession, I think those good opportunities will disappear. And that is my presentation. There's some summary information on the properties which will be available on the website and in your booklets, and I'm happy to take questions.
The outlook for the economy as a whole has, as you all know, deteriorated. We see no real improvement in the outlook for offices, although having said that, we are in the process of being final bidders in a number of large new premium grade developments, but other than that it remains very soft. The restructuring of our core portfolio is expected to continue to bear fruit in 2013. We're really not looking to sell any large chunks of our portfolio, save and except if it was possible to substantially reduce our exposure to government. A strict focus will continue on cost containment and sweating the assets. We had a particularly successful year with that now, and we hope we'll be able to do that. New funding will be from investment disposals, if any, and the debt capital markets. The full year distribution is expected to grow between 5.5% and 7%, and we remain focused in its pursuit of revenue enhancing opportunities. Okay, I suppose now we will have most of the questions and stuff. Our Fountainhead offer, just to explain to you what our position is, and obviously we have a view, I suppose the Fountainhead board has a view, and the competing offer from Growthpoint has a view, and at the end of the day it will be resolved, I'm reasonably confident, one way or another in our favour. But just to show you how we see this, first of all you have a PUT. It has assets which generate net income, and that net income there is an entitlement in terms of Cisco and the Fountainhead trust deed that income goes to the investors and to the management company. If the manager sells the portfolio and doesn't replace it with any other income producing assets, it's normal, appropriate and legally necessary for the manager to ensure that the investors and the manager who are entitled to participate in the income are adequately compensated. It would be inappropriate to allow one of the parties to benefit from the income stream of the other. The value of the investor's interest in Fountainhead is the future value of the cash flows generated by its assets. The value of the asset manager's right to manage the fund is the future value of the cash flows arising from that right. A disposal of the portfolio and the distribution of the proceeds to investors is a disposal of the investor's rights to receive income from the units and a disposal of the manager's rights to asset manage the portfolio. So if the entire portfolio is sold and the proceeds distributed, then the purchaser acquires all of the income and not just that portion which is attributable to the investors. If the investors were to obtain the benefits of the income attributable to the asset manager, their cash flows, based on consensus, and that's before the Fountainhead results today, would increase from 59 cents a unit to 64.3, which results in a 9% increase in the value in the asset achieved simply by investors expropriating the manager's asset without compensation. This is contrary to a fundamental principle of law that no party may be deprived of ownership of an asset without compensation. Growthpoint's offer is based on expropriating the income attributable to the manager without compensating either Fountainhead, the manager, or the investors, but obtaining this benefit for themselves. Or as I said to somebody the other day, my good friend Norbert now thinks he's David Copperfield and can make 63 million disappear. With that, I'm happy to take questions.